Greetings, tax tip lovers, and welcome to this week's top 5 tax fixes in just 5 minutes. Come gather around people to ponder the best tax planning pension options for property investors. Property owners often have at least some knowledge of the existence of small self administered pension schemes, SAS, and if not, it's a short trip by Google to find plenty of experts telling you what they think, whether they know it or not. SAS is likely most suitable for company directors and business owners, given the scope to complement the sponsoring employer's own financial plans by making a loan from the scheme to the company or tailoring the level of contributions made for maximum tax efficiency. And assets are pooled, so it makes it easy for succession planning. Okay, so let's look at things from a tax planning perspective by referencing HMRC rules first published back in 2016 in its company tax manual, as it may relate to property investment companies. Now, Rethink.tax clients can just go enjoy your breakfast because you're already sorted, as it's our job to monitor all the tax efficiencies allowed by legislation. Okay, here we go with a little help from Glenn Frey and Don Henley as we count down the top 5 considerations for tax planning for property owners using pensions. Static at this week's number 5 is you can spend all your time making money. Generally speaking, if the aim is that a company director should have a pension scheme, then contributions made by the company will attract tax relief and also save national insurance contributions. This is basically problem-free for trading companies, but what if it's an investment company? Down at this week's number 4 is you can spend all your love making time. Could employer pension contributions on behalf of a director shareholder still be an allowable expense? And are the pension contributions a management expense? And is there a time limit on the tax relief? Just inside this week's top 3 is if it all fell to pieces tomorrow. Well, HMRC's company tax manual gives us the tax authority's position. It seems that pension contributions made by an investment company are generally accepted as allowable expenses for tax purposes. A new entry at this week's number 2 is would you still be mine? Although the wholly and exclusively test does not apply to investment companies, the expenses still need to be reasonable, having regard to the requirements of the company's business. Therefore, in line with a trading company, consideration should be given to the overall remuneration package of the director. Staying at number 1 is the all-time classic, take it to the limit one more time. So, pension contributions for a director shareholder of a property investment company could, in principle, be an allowable expense, and the conditions for relief are no different. Current HMRC rules allow some businesses to provide a defined benefit DB SAS, and that might be really useful for company tax planning as the maximum contribution for a member is calculated based on the capital value of the increase of benefits within the scheme, meaning that the contributions paid by the employer could far outweigh the annual allowance. We refer clients seeking pension advice to a G60 qualified, FCA approved specialist who tells us the biggest single contribution he's seen HMRC allow corporation tax relief on is £1.4 million in a tax pre-approved pension fund, and corporation tax relief on all of it day one. Just maybe George Bernard Shaw had a point when he said, people who say it cannot be done should not interrupt those who are doing it. It's likely there'll be changes to pension rules in the autumn budget, and that's just around the corner. But changes to DB SAS may not be politically acceptable, as it involves a choice between penalising public sector workers or enabling high earners to contribute more to their pensions, with both using similar rules. Okay, that's it. Pension tax planning is a technical subject and it affects us all. But as Bob Marley reminds us, remember that when the rain falls, it don't fall on one man's house. Of course, if tax planning for property companies using pensions was easy, everyone would be doing it. Well, our team make it easy and you should be doing it. It's time to take action to sort your pension tax planning, and here's how. You can do nothing and stay in the exact same place and pay a shed load of tax unnecessarily, or you can follow the link above for a free Power Hour review with property tax experts who are ex PwC and ex HMRC, and will make your property tax planning like it was our own. And that's our take on tax efficient pension planning for property owners and why we believe you need to take action, tax tippers. All right, stay bright. Catch you again for breakfast next week. Ta